guest. Let's bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show. This morning, in fact, you wrote about the fact in the Economic Times that a lot of investors across our country view equity funds as far more risky than investing even in stocks directly. In fact, you did say that a lot of investors view equity funds as the most risky investment of all. Tell us why you think this impression has been created among investors.
Oh, this is a very alarming perception, and then thinking loudly about it, I realized that a lot of investors don't invest in stocks directly anymore, and their first experience, and most individual investors also do not invest in fixed income funds because they have deposits available or post office as a fixed income option available. So the only experience they have with equity is with the equity fund. And first-time investors have normally, invested in equity fund, normally at the wrong time. Normally, last time they invested in large number was in 2008. They were extremely disappointed, and they carry a perception that it is the most riskiest form. So they are actually not forming a relative view because they have not experienced other parts. In fact, it is so alarming when we compare with the fixed income investments of mutual fund, which is nearly 2/3 of the industry, or the relative riskiness of individual stock compared to mutual fund, but they haven't experienced any of that. Their experience with mutual fund is disappointing, and that is what is driving the perception. That is what has driven this perception.
Well, how should investors use equity funds in their portfolios? Now, battling this impression that it has a lot of risk, can you give us a few pointers that we can use equity funds and still manage to control the risks that they bring in?
Oh yes, the simplest way of doing it is, invest your long-term money into equity. Start conservatively, start with a balanced fund. If you are not investing for many years, or at least for a few years, don't even think of it, and invest regularly. Don't invest only through SIP. And if you do this, your understanding of equity will be very different. You will also experience the rewards of equity, and that is perhaps the only way to beat inflation. And any other way you do it, you will be disappointed, because if you invest in an IPO, in a stock, or invest in a lump sum money in a NFO, you will be disappointed, because when it is easy to invest, it is normally a wrong time to invest.
Before we run out of time, very quickly, Dhirendra, you always tell us to use diversified funds because they're safer than sectors and thematic funds. Could you take us through why very quickly?
The reason why, the only thing which investors have in their control is to diversify, invest regularly, and invest their long-term money so that they don't get anxious. And sector funds are, is a concentrated bet. It is a targeted bet on a particular sector. So you should. There is a very limited utility of the sector fund when you find that in your portfolio something is amiss and you want to supplement that. Other than that, I don't think sector funds make sense for any individual investor.